Thanks to you at home for joining us this hour. It is Monday evening, March 16th, 2026. And I want to start tonight with something that happened while you were sleeping. Actually, while you were sleeping, while you were having your Sunday dinner, while you were scrolling through your phone this weekend, something shifted. Something cracked. And by the time you woke up this morning, the world had changed in a way that most Americans haven't experienced in their adult lifetimes. For the first time since the summer of 2008, oil prices have blown past that psychological barrier, that number that makes traders gulp and makes central bankers reach for their blood pressure medication. $100 a barrel. Actually, as of this morning, Brent crude, the international benchmark, is holding at just over 100. West Texas Intermediate, that's our U.S. benchmark, is trading above 96.50. But here's the thing, it cracked 100 late Sunday night. And the question everyone in every finance ministry, every trading floor, every central bank from Washington to Frankfurt to Tokyo is asking right now is not how did we get here? It's how much higher? And the answer to that question depends entirely on something that is happening 6,000 miles away from here, in a narrow strip of water you probably studied in 7th grade geography and haven't thought about since. The Strait of Hormuz. It's this tiny choke point between the Persian Gulf and the Gulf of Oman. At its narrowest point, it's just 21 miles wide. 21 miles. For context, that's about the distance from Midtown Manhattan to the southern tip of Staten Island. You could drive it in about half an hour, traffic permitting. But through that 21-mile stretch, about 20% of the world's oil passes every single day. Something like 17 to 18 million barrels of crude oil every 24 hours. Squeezed through a channel that in some places is so narrow that ships have to use designated sea lanes to avoid running into each other. And right now, that strait is effectively closed. I want you to let that sink in. The most important energy artery on planet Earth is closed. Not entirely, not completely, but for all practical purposes, for the global oil market, it is a parking lot. And it's a parking lot because of what happened this weekend. Late Friday night, U.S. forces struck military assets on Karg Island. Karg Island is Iran's primary oil export terminal. It handles about 90% of Iran's crude exports. So when the United States strikes there, even if the target is military, the message is clear. We can turn off your economy. And Iran responded. Not by directly hitting U.S. forces, but by launching drone strikes on the port of Fujairah in the United Arab Emirates. Fujairah is a critical hub for oil storage and shipping, located just outside the Strait of Hormuz. Those strikes halted oil loadings. So now you have a situation where the world's most important oil artery is closed, and one of the region's key alternative ports is under attack. This is strategic. If you're a tanker operator or an insurance company, you're not sending ships through a war zone. So the tankers sit. Or they take the long route around the Arabian Peninsula. The result is simple. The global oil market has effectively lost access to 20% of its supply. That is why oil prices are surging. Morgan Stanley has already raised its oil price forecast dramatically. They now expect oil to average around $110 per barrel in the second quarter. That is a massive jump from earlier expectations. And analysts across the world are rewriting their models. Because the old models assumed the Strait of Hormuz would remain open. Those assumptions are now broken. The phrase being used is a high-stakes stalemate. A situation where neither side can win easily. But neither side is willing to back down. And while the military situation is stuck, the economic consequences keep spreading. Because oil affects everything. It affects transportation, manufacturing, food production, and global trade. When oil prices rise, the cost of living rises. And that brings us to central banks. The Federal Reserve, the European Central Bank, and the Bank of England are all meeting this week. Just weeks ago, economists expected rate cuts. But oil at $100 changes everything. Central banks cannot cut rates while energy prices are rising. That would fuel inflation. So now the expectation is that rates will stay higher for longer. That means higher borrowing costs, higher credit card interest, and more pressure on households and businesses. Economists are even warning about stagflation. high inflation combined with slow economic growth. And despite all of this, markets are not fully panicking yet. Many investors believe this crisis will pass. But some economists warn that the risks are being underestimated. Because if the conflict continues or escalates, oil prices could go much higher. 120, 150, or more. At those levels, the global economy could enter recession. History shows how dangerous energy shocks can be. The oil crises of the 1970s caused massive economic disruption. And every time the Strait of Hormuz is threatened, the entire world feels it. Because this narrow waterway is one of the most important choke points in global trade. Countries across Asia and beyond depend on it for energy. And right now, it is not functioning normally. So the world waits. Waiting to see whether diplomacy will succeed. Waiting to see whether the stalemate continues. Or waiting to see whether the situation escalates into something far more dangerous. Because tonight, the global economy is holding its breath. Oil is at $100. The Strait of Hormuz is effectively closed. And the future is uncertain.